All right, today we're going to pull back the curtain on one of the most powerful and honestly most overlooked tools in commercial real estate. We're talking about a hidden blueprint that pretty much dictates a building's entire financial future.
So, let me just ask you this. When you picture a massive billion-dollar skyscraper, what do you think is its greatest threat? An earthquake? A fire? Maybe a big market crash? I mean, yeah, those are all really serious for sure. But the biggest, most constant threat, it's actually something a lot quieter.
That's right. The single biggest threat isn't some huge physical force. It's just the relentless ticking of the clock and the turning of calendar pages. It's a threat that's literally baked into the DNA of the building's whole business model.
You see, every single commercial building, I don't care if it's a local strip mall or a giant downtown high-rise, it is operating against a ticking clock. And that clock, it represents the lifespan of its leases. The agreements that generate pretty much all of its income. And when those leases run out, well, so does the cash flow.
To make this feel a little more real, just imagine for a second that you own a building. And in one single 12-month window, you were staring down the barrel of losing almost half of your entire rental income. Tenants could just pack up and leave, spaces could sit empty for months, and the financial stability of your entire asset could be thrown into absolute chaos. And look, this isn't just some hypothetical scenario. It's a very, very real risk that asset managers deal with all the time.
This chart right here, this perfectly captures the villain of our story, what we call the lease cliff. It's this massive concentration of expiring leases all hitting at the exact same time. That huge spike you see, that represents a moment of extreme vulnerability for the building. It's a financial cliff edge that any smart owner wants to avoid at all costs. Okay, so how do you fight a monster like the lease cliff? Well, not with brute force, that's for sure. You fight it with foresight. And this is where the hero of our story comes in, a simple but incredibly powerful document called the rollover schedule.
At its heart, a rollover schedule is basically a timeline for your building's income. It's really just a spreadsheet that lists every single tenant and, this is the important part, the exact date their lease expires. This simple tool takes what could be a chaotic jumble of future events and turns it into a clear, strategic roadmap.
Now don't be fooled by how simple this looks. This basic table is the command center for the entire building. By tracking the tenant, how much space they have, and that critical expiration date, an owner can essentially see into the future. They can pinpoint which years are going to be calm and which years, like that lease cliff we just saw, are absolutely packed with risk.
But here's the thing. This isn't just a defensive tool for, avoiding disaster. A well-managed rollover schedule is also an offensive weapon. It's used not only to protect the building's value, but to actively increase it. It's all about playing both defense and offense at the very same time.
So on the defensive side, the schedule helps you dodge those cliffs, accurately project your income, and budget for things like commissions and tenant improvements. But on offense, and this is where it gets fun, it helps you spot tenants who are paying way less than the current market rate. It lets you strategically stagger your leases for more stability, and it can even show you the perfect moment to renovate or totally reposition the asset.
Now, this roadmap is so powerful that a whole set of key metrics, think of them as the vital signs of a building's health, are pulled directly from it. And these are the numbers that buyers and lenders look at first to figure out what they're really dealing with.
The first, and you could argue the most important, is the weighted average lease term, or WALT for short. Think of it like this. The lease of a huge tenant occupying 10 floors obviously matters a lot more than one occupying a tiny little office. WALT gets that. It accounts for the size of the tenant. So in short, it tells you how long, on average, your most significant income streams are locked in. It's really the ultimate measure of financial stability.
So when you see a building with a high WALT, say 7.5 years, what does that tell you? It just screams security. For a lender or a potential buyer, this is fantastic news. It means the income is predictable and safe for a long, long time. There are way fewer near-term risks to worry about.
But then you see this, a low WALT, something like 2.2 years. Yeah, that's going to set off some major alarm bells. This signals immediate uncertainty and risk. It tells an investor, hey, a lot of leases are coming up for renewal really soon, which means they'll have a ton of work and a lot of potential vacancy to deal with right away.
All right, the second key metric, this one is all about finding hidden gold. A mark-to-market analysis.
uses that rollover schedule to compare what a tenant is currently paying in rent to what a brand new tenant would have to pay for that exact same space today.
And this is where the magic happens. You see the concept of upside right here. If a tenant's lease is about to expire and they're paying, say, $25 a square foot, but the going market rate is now $35, that is a huge opportunity. The owner can potentially boost their income from that one space by 40% when the lease rolls over. This is how real value is created.
But look, just having all this data, that's not enough. The best asset managers use the rollover schedule as a proactive playbook. It literally dictates their actions months and sometimes even years in advance.
You see, a sophisticated owner never waits for a tenant's lease to be a month away from expiring. No way. They're reaching out a year and a half in advance. They're deep in negotiations or already marketing the space a full year out. This whole proactive approach, which is all driven by the dates on that schedule, it minimizes downtime and it maximizes the chances of a successful renewal or finding a great new tenant quickly.
So let's say you're looking at a rollover schedule. What are the big red flags you need to spot? Well, first, that lease cliff we talked about. A short wallet is another big one. If one single tenant makes up a huge chunk of the income, that's concentration risk. And that last one is a bit sneaky. If all the current leases are already at or even above market rates, it means there's very little room to grow the income. The upside is already gone.
You know, this quote just nails it. It really captures the essence of this whole thing. The schedule is not some dusty report that sits in a file cabinet. It's a living, breathing blueprint that the pros use every single day to make decisions that protect and grow the value of their property.
Which kind of leaves us with one final thought, right? We've seen how just organizing some simple data, names, dates, and numbers can literally unlock a building's future and turn massive risk into huge opportunity. So the question for you is, what hidden schedules or unseen patterns in your own work, or even your own life, could, if you just understood them properly, become your own strategic roadmap?